In this discussion, we will discuss the discussion question of list and describe the 4 categories of financial ratios. When we see a discussion question or essay question like this, our goal is typically to add more detail to the information if possible, if time allows, that being more likely for us to pick up more points on something like an essay question because we're more likely to touch on what is being looked for. And within a discussion question, our goal is to add more content to the discussion. Therefore, we often have to expand on the question in order to add more information relevant to the discussion. Keeping that in mind, let's take a look at this one more time. List and describe the 4 categories of financial ratios. One way to add more discussion oftentimes is to try to take a step back and say, okay, what are financial ratios? How do they fit into the big picture? What's going to be the goal and objective of the financial ratios? And we can think of them as a type of financial statement analysis, and we can think of them in terms of who would be using them, who would be using financial statement ratios. They could be used by both internal and external users. So they might be used, in other words, by management. They might be used by external users such as investors. So typically we have the financial statements, which is what's going to be created in financial accounting. The ratio analysis, we can kind of think of it as a component of financial analysis or financial accounting in some way, because we could use those ratios with regards to the financial statements. But we can also think of them as an outside investor type of activity, what the investors or what the outside users would be using in order to analyze the financial statements that we would put together in financial accounting. We can also think about them being useful in managerial accounting for internal types of decision-making processes. Then we can go into the ratio analysis. What are ratios, financial statement ratios? These are typically going to be things that are going to be helping us give some insight into the financial statements. We can go into the types of financial statement analysis, which includes ratios. The types of analysis typically being vertical analysis, horizontal analysis, ratio analysis. The ratio analysis typically taking key components of the financial statements and then comparing them, some type of ratio, some type of division problem typically, in order to give us some insight about the data that we are taking a look at. One way to group the ratios and know what we are getting at or looking for is to group them into separate types of categories. These categories then are going to give us some idea of what the ratios are telling us, what they're supposed to be geared towards. And many of the ratios, of course, are going to be kind of common ratios, standard types of ratios, best practices types of ratios that will be useful across different companies, and therefore we could group them into standard types of categories. Oftentimes we have around 3 or 4 types of categories that we'll group ratios into. We have liquidity and efficiency, we have solvency, we have profitability, and we have market prospects. So we could list out those categories and then consider what each of these categories are going to be dealing with. So the liquidity and efficiency are dealing with the ability to meet short-term obligations and efficiently generate revenue. That's going to be the objective of liquidity and efficiency ratios. The most common types of ratios there are going to be the current asset ratio, the quick asset ratio, and our goal there is to try to see, okay, the current liabilities are things that are going to be due within a short time period, within a year. Are we going to be able to pay those off? Are we able to pay off the short-term liabilities? That then comparing oftentimes the current liabilities and the current assets, as well as other types of calculations that will deal with being able to pay off the short-term types of obligations. Now note, of course, one way to look better for liquidity and efficiency type ratios is to say, yeah, we could pay off the short-term obligations by possibly making some of our debt not short-term but long-term type debt, and therefore that will improve possibly liquidity ratios, but it may still have a problem for long-term debt, and that's what we would basically look into with solvency. So when we consider solvency type ratios, we're talking about the ability to generate future revenues and to meet long-term obligations. So in that case, we're thinking about, okay, now we're taking into consideration those more long-term types of obligations within the solvency ratios. Common solvency ratios include debt ratio, equity ratio, debt to equity ratio, times interest earned ratios. Then we have the profitability ratios. Those have to do with the ability to provide financial rewards sufficient to attract and retain financing. With profitability ratios, we're considering how we're doing over time. We're considering the progress that we are making. Are we doing well in terms of measurement of performance? So typically we're thinking about items that may be on the income statement or including income statement type items, those being the temporary type accounts. Profitability ratios can include profit margin ratio, return on total assets, return on common stockholders' equity. Then we have market prospects. These are going to be types of ratios that include market activity. So note that there's something that's not just going to be included within the data to the financial statements. We have to include outside data, including the market price of the stocks typically. So the market prospects are the ability to generate positive market expectations. That's what we're looking for with regards to the market. And note that those are typically going to include, once again, items and stuff, information that's going to be outside of the normal business, and they're going to be including what the market thinks about the business, and how do we know that? By judging the market price. So those include things like the price earnings ratio and the dividend yield. If we had the time and wanted to go into more detail than that, we can start to go into the types of ratios that are going to be within each category. So if we go look at liquidity and efficiency, we could start saying, well, here's the current ratio. The calculation is going to be current assets divided by current liabilities. And then we can start to analyze what that would mean. We can actually give examples if we wanted to give examples for it to show what that could mean or what kind of things would change this ratio. We could talk about the acid test ratio, comparing quick assets to current liabilities, comparing and contrasting it oftentimes to the current ratio. We could talk about the accounts receivable turnover ratio, how to calculate the accounts receivable turnover ratio, the sales or net sales or sales on credit divided by the average accounts receivable. We could talk about the total asset turnover ratio, which is sales or net sales divided by the average total assets. Inventory turnover ratio, calculated as cost of goods sold divided by the average inventory. Days sales uncollected, current receivables divided by net sales times 365, days sales in inventory. So we can list those out if we have the time to list those out. That's always a way that we can expand on a discussion and or essay question. Solvency ratios, we have the debt to equity ratio, we have the debt ratio, we have the equity ratio, we have the debt to equity ratio, the time interest earned. Again, we can go through the same type of analysis for each ratio if we so choose, given examples if we so choose. Profitability we includes profit margin ratio, return on total assets, return on common stockholders' equity. We could go through those calculations and give examples. Market prospects goes into price earnings ratio and the dividend yield. We can go through those calculations and give examples there as well.